Welcome back to the Deep Dive. We're here to cut through the noise, dig into the research, and give you the insights you need.
Yeah, that's the goal.
Today we're tackling a really interesting one. It's this mix of, well, high-tech dreams and maybe some shaky ground underneath. MicroAlgo Inc. The ticker is MLGO on the NASDAQ capital market.
Right. MLGO. It's a Chinese tech company, microcap, focusing on algorithms. And the core question we kept coming back to is this. Everyone's chasing AI, right?
Absolutely.
So can this company, which looks statistically, well, dirt cheap compared to its peers, actually be a long-term value play? Or is all this talk about quantum breakthroughs really a warning sign for careful investors?
That's the tension we felt throughout the analysis.
Yeah.
Either the algorithm dream or a serious value trap. That's what we set out to explore, looking at it like a long-term value investor would.
Focusing on the fundamentals.
Exactly. So we've structured this deep dive into two parts. In part one today, we'll cover the internals, the business itself, the management team, and the financials.
And then in part two, we'll look outwards, market sentiment, that, frankly, astonishing ownership structure, and the very serious geopolitical risks involved.
Okay, let's get started then. Let's look under the hood first. Chapter 1, Business Analysis, the Engine of Value.
All right, so when you first look at MicroAlgo, you pretty quickly see this, this kind of split personality.
Yeah, there's the story they tell, the high-tech image, and then what the numbers actually show happening operationally.
Exactly. So segment one is that public face, central processing algorithm services. This is where you hear about the R&D, the quantum computing stuff, Grover-based algorithms, quantum image encryption, you know.
Sounds impressive. Cutting edge.
That's the idea. Revenue supposedly comes from putting these proprietary algorithms into client systems. Think internet advertising, gaming, finance.
Okay, sounds like a pure AI research firm. But you mentioned a split. What's the other side?
Well, segment two is called intelligent chips and services. And this is more like the day-to-day operational reality. It's basically a conventional hardware distribution model, meaning they resell intelligent chips, accessories, standard stuff, lower profit margins, inventory risk, the whole package.
And critically, the financial data showed these two parts were, what, roughly the same size at one point?
Yeah, back in 2021, they were comparable. And that's the key disconnect. They present like a pure quantum AI innovator, but a big chunk of the business seems to be this much less glamorous, lower margin hardware resale. It's not purely cutting edge AI.
Got it. And size-wise, they're definitely small fish, right? A microcap.
Oh, absolutely. Trailing 12-month revenue is hovering around, say, $61 million, and the market cap bounces between maybe $110 and $150 million. Tiny in the grand scheme. Their pitch is basically helping clients be more efficient, save costs through optimization.
Okay, and here's where things get, well, confusing maybe. You mentioned AI and chips. That market is booming.
It's exploding. The semiconductor market is forecast to grow, 11% in 2025, heading towards $1 trillion by 2030, driven almost entirely by AI demand, especially generative AI. Massive tailwinds.
So MicroAlgo must be riding that wave, getting pulled up by this massive tide.
You'd think so, but no. They're actually going the other way. Their revenue peaked back in 2022, and it's been declining since then.
Declining. In this market.
Yeah, which strongly suggests they're either losing market share or they just don't have a lasting competitive advantage. Failing to capture any part of this industry boom, that's a serious, serious red flag.
And the competition is fierce, I imagine.
Intense. They're up against giants, global players, and strong domestic Chinese firms like Huawei, Baidu. They don't have the brand recognition, the scale.
So their only real edge is supposed to be those quantum algorithms.
That's their claim. But the analysis was clear. Those algorithms are still unrealized and unproven in the marketplace. It's all potential. No actual market validation yet. It's not a moat you can rely on today.
Okay, that sets the stage for the business itself. Let's talk about who's actually running this company. Chapter 2, Management Evaluation.
Right, the leadership. We're looking at the CEO, Min Shu, and the CFO, Lu Shi. Both have been there about just under 3 years.
And they both came from the parent company, right? Wumi Hologram Cloud Inc.
That's correct. Ties to the parent company.
Now, this chapter in the research, it felt really thin. The main takeaway seems to be just how little information is out there about these leaders. Opacity feels like the key word here.
It really is. There's a striking lack of, well, anything detailed. No shareholder letters explaining strategy, no in-depth interviews, no substantive conference call transcripts where they really engage with analysts or investors about the long-term vision.
And the way they got listed, through a reverse merger, That often means less initial vetting than a traditional IPO, doesn't it?
It certainly can, yeah. Less scrutiny up front.
And their communication since then hasn't exactly filled the gap. Just formal press releases, mostly about the tech breakthroughs and the legally required SEC filings. No regular earnings calls, no investor days.
It's minimal. And when management is that quiet, especially in a field like this, it raises questions. Why wouldn't you be out there talking up your high growth potential if you really believed it?
And that silence lets other narratives take hold.
Exactly. The market abhors a vacuum. And while it's crucial to state this isn't a formal charge or finding, just market commentary, the stock has been associated with pump and dump talk. That kind of speculation thrives when management isn't communicating openly.
Looking at their actions, their capital allocation, R&D spending actually went down recently.
It did drop from about $22.7 million in 2023 to $15.3 million in 2024.
And they've explicitly said no dividends, no share buybacks.
Correct. No plans to return capital to shareholders that way.
What about how effectively they use the capital they do invest? The returns.
Pretty weak, honestly.
Yeah.
Return on invested capital, ROIC, it bounces around, but it's low, maybe 6.5%. For a high-risk company in this space, a microcap, that's just not an adequate return to compensate you for the risk you're taking.
Okay, weak returns, declining R&D spend, lack of communication. Not a great picture. Before we dive into the financials, just a quick word. We know your time is valuable, so we try to keep these deep dives sharp and focused. But if there's a specific stock you're looking at, one you want us to tackle, the best way to let us know is to like this video and subscribe to the Stock Analytics AI YouTube channel. For just $4.29 a month, members get priority requests for deep dives. We put your tickers at the top of our list. Okay, let's crunch some numbers. Chapter 3. Financial analysis.
All right, the financials. And this is where that initial hook comes in. The stock's trading around $12.11, right?
Yeah.
And the trailing 12-month PE ratio is, well, it's shockingly low. Somewhere between 0.5x and maybe 4.9x earnings. Statistically, on paper, it looks like an unbelievable bargain.
Dirt cheap, as you said. But the context really matters here, doesn't it? That revenue growth we talked about.
It's completely stalled. Worse than stalled, it's reversed. They went from huge growth back in 2020 to a decline of over 9% in 2024. That trend is just bad.
And earnings are all over the place.
Extremely volatile. They swung from a huge loss, nearly $38 million in 2023, to a small net income of about $5.3 million in 2024. Wild swings. And the gross margin is okay, but not spectacular, around 28%.
Now, you mentioned something about cash flow versus profit. That's often a warning sign.
It is, and it's a classic red flag we see here.
Yep.
There's a big difference, a divergence between the profit they report on the income statement and the actual cash the business is generating.
How big a difference?
Despite showing that positive net income in 2024, their free cash flow actually declined by almost 78% compared to the previous year.
Wow. So the accounting profit might be there, but the actual cash coming into the business is drying up.
That's what it suggests. It points towards deteriorating business quality, something hidden beneath the surface of that net income number.
Okay, that's worrying.
Yeah.
But there's a flip side, right? The balance sheet.
There is.
Yeah.
And it's the one undeniable strength here. Their balance sheet is, frankly, pristine, almost no debt. Debt to equity is tiny, like 1.3%.
And the liquidity.
Off the charts. The current ratio, that measure of short-term assets versus short-term liabilities, is exceptionally high. It's 33.05.
33. That's massive.
It's huge. It means they have 33 times more current assets than current liabilities. Essentially zero risk of short-term insolvency. It's a fortress balance sheet in that sense.
But hang on a second. Let's connect the dots.
Yeah.
You said their ROIC, their return on investment, is low, maybe 6.5%.
Right. Inadequate.
And they're sitting on this enormous pile of cash, implied by that crazy current ratio.
Mm-hmm.
And they've said they won't pay dividends or buy back stock.
Correct, on all counts.
So doesn't that suggest that management knows they don't have good places to reinvest that cash internally? If your business was truly on the cutting edge of quantum AI with huge growth prospects, wouldn't you be pouring that cash back in? Why just let it sit there earning minimal returns?
That is exactly the critical question, and it leads right into this whole valuation paradox. Yes, the PE ratio looks like a steal, like the market's missed something.
Wow.
But our analysis concludes this is very likely a classic value trap. The market isn't missing something, it's applying that huge discount for a reason. It reflects a profound lack of confidence in the quality and sustainability of those earnings. It's pricing in all the weaknesses we've just talked about, the revenue decline, the opacity, the questionable returns.
So trying to value this with something like a discounted cash flow model Must be incredibly difficult.
Extremely sensitive to your assumptions. To even get close to a realistic valuation reflecting the current situation,
You'd have to assume what? Negative growth.
you'd almost certainly have to project negative revenue growth for the next year or two, say -5%, just to match the recent trend. And crucially, you need to use a very high discount rate,
How high?
easily in the 20% to 25% range, maybe even higher. That's the only way to compensate for the extreme operational risks, the management opacity, the industry headwinds they're facing, and, well, the structural issues we'll get into. That high discount rate drastically pushes down the calculated intrinsic value.
Okay, so the internals look shaky despite the cash pile. Let's move on to how the outside world sees this stock. Chapter 4, Market Sentiment.
Right. What does the market think? And honestly, the most telling sign is probably silence.
Silence from who?
From Wall Street analysts, mainstream investment banks, brokerage firms, there's zero analyst coverage.
None at all.
Zero. In fact, some data providers actually list the consensus price target as $0.
$0. What does that even mean?
It's basically Wall Street code for don't touch this or uninvestable. The lack of any institutional analysis or validation is a really powerful negative signal. You just can't ignore that.
So if the professionals aren't talking about it based on fundamentals, who is? What's the narrative out there?
It's completely split. On one side, you have the company itself pushing out press releases about quantum R&D breakthroughs.
The high-tech dream narrative.
Exactly. And on the other side, you have independent commentary, bloggers, forums, framing it mostly as a highly speculative trading vehicle, something driven by retail sentiment, rumors, maybe social media hype, but completely disconnected from the underlying business reality.
Interesting. But the stock price itself has been strong recently.
Technically, yes. That's the strange part. It's been trading significantly above both its 50-day and 200-day moving averages. So you have this real conflict. The technical chart pattern looks positive, showing momentum, but the fundamental picture we've just painted is, well, pretty negative.
That's a tough situation for traders. What about people betting against it? Short interest.
It's moderate. Around 6% of the publicly available shares are sold short. So there are some doubters, but it's not an overwhelming short position right now, not necessarily primed for a massive short squeeze based on that number alone.
Chapter 5, Ownership Structure.
Okay, now we need to talk about who actually owns this company. And this is where things get really, really critical.
We already know institutional ownership is basically zero, right? And it's hard to track insider trades because it's a foreign private issuer.
Correct. Minimal institutional interest, very little transparency on insider activity, but the absolutely dominant factor, the one that overshadows everything else, is the control structure.
The parent company again. WeMe Hologram Cloud.
Yes. MicroAlgo isn't really an independent public company in the way you normally think of one. It's a controlled subsidiary. And Weenie Hologram Cloud Inc. beneficially owns, get ready for this, 99.79% of MicroAlgo's total outstanding shares.
Wait, did you say 99.79%?
99.79, yes.
So the public float, the shares that ordinary investors like you or me can actually buy and sell on the NASDAQ, that's less than 0.21%.
Precisely. An incredibly tiny fraction.
That's not just majority control, that's practically total ownership by the parent. What does that mean for someone holding those few public shares?
It means you're essentially powerless. WeMe has absolute unilateral control over everything. Major corporate decisions, mergers, acquisitions, selling assets, issuing more stock, changing strategy. They can do whatever they want, primarily for their own benefit as the parent company.
And the interests of that tiny minority of public shareholders might be completely disregarded.
They could be. There's very little recourse if the parent company makes decisions that harm the value of those public shares but benefit WeMe overall. You're entirely exposed.
And this structure, this minuscule float, that must be why the stock price is so incredibly volatile.
It's the primary driver. Absolutely. When only 0.2% of the shares are available for trading, even a small amount of buying or selling pressure can cause absolutely massive, unpredictable price swings.
Like that 52 weeks range you mentioned earlier.
Exactly. Going from a low of $7.82 all the way up to $972 in a single year. That's not rational price discovery based on business value.
Sounds more like a lottery ticket.
Or a roulette wheel, yeah. The price action becomes completely detached from fundamentals and is driven purely by the mechanics of that tiny float. It makes it virtually impossible for a prudent, long-term investor to manage risk.
Chapter 6, Risk Assessment.
Okay, let's try to pull all these risks together. We can think in terms of strength, weaknesses, opportunities, threats a SWOT analysis.
Right. The strengths seem pretty clear. That flawless balance sheet, the massive cash pile, and the fact they recently turned profitable again, even if the quality is questionable.
Mm-hmm. And the weaknesses are also stark. That multi-year revenue decline in a booming market, the opaque management team, the lack of communication, and now this overwhelming 99.79% ownership concentration.
The opportunity is obvious, too, if they could actually leverage that R&D and capitalize on the enormous AI and quantum computing growth trends. That's the dream scenario.
But then we get to the threats, and this is where we move beyond just standard business risks into things that could be, well, existential for the stock.
More than just competition.
Oh, yeah. Competition is intense, facing giants and nimble local players. We covered that. But the really big threats are geopolitical and regulatory, specifically because it's a Chinese tech firm listed in the U.S.
These are the binary risks, right? Things that could potentially make the shares worthless overnight.
Exactly. There are several major ones looming. First, there's the HFCAA, the Holding Foreign Companies Accountable Act.
That's the one about audits.
Right. If the U.S. regulatory body, the PCAOB, can't inspect the company's audit papers for 3 consecutive years, something China has historically resisted, the stock faces mandatory delisting from the NASDAQ. That's a direct threat.
Okay, delisting risk. What else?
Second, the VIE structure risk. Many Chinese companies listed in the U.S. use a variable interest entity structure. It's a complex legal setup using contracts, not direct ownership, to get around Chinese restrictions on foreign investment in certain sectors.
And the risk is?
The risk is that the Chinese government could, at any time, declare these VIE structures illegal or invalid. If that happened, the contractual arrangements underpinning the U.S.-listed shares could evaporate, potentially rendering them worthless. It's a known, significant structural risk for many Chinese listings.
Wow. Okay, delisting risk, structure risk. Anything else?
Yes. There are new U.S. outbound investment rules set to take effect in 2025. These are designed to restrict American investment flowing into sensitive Chinese technology sectors, specifically mentioning things like AI, semiconductors, and quantum computing.
So that could directly limit future investment demand for MicroAlgo from U.S. sources.
It certainly could put a damper on institutional interest down the line, adding another layer of uncertainty. When you stack these severe geopolitical and regulatory threats on top of the fundamental weaknesses in the bizarre ownership structure, the overall risk profile becomes extremely high.
It makes quantifying a safe entry point incredibly difficult. Chapter 7, conclusion. All right, let's bring this all together. We started with this company, MicroAlgo, trading around $12.11 share. And the initial hook was that super low PE ratio, right? Looks cheap.
Yeah, the bull case, if you can call it that, really rests on just a few things. That statistically low valuation, the undeniable strength of the balance sheet with all that cash, and the theoretical potential of their quantum algorithm R&D. That's the dream.
But the bear case seems substantial.
It's overwhelming in our assessment. You've got the multi-year decline in revenue despite a booming market. You've got opaque management with poor communication. You have that absolutely critical 99.79% control by the parent company, WeMe, making public shareholders essentially powerless.
And then layered on top, those severe geopolitical and regulatory risk, potential delisting, the VIE structure instability, upcoming U.S. investment restrictions.
Right. And remember our valuation discussion. To even justify the current price, you probably need to assume negative growth and apply a massive discount rate, maybe 20–25%, just to account for all these risks.
So the final verdict, algorithm dream or value trap?
Based on this deep dive, the conclusion is pretty clear. The current share price of $12.11 does not offer a sufficient margin of safety, given the profound and diverse range of risks.
So the market isn't crazy for giving it such a low PE.
It appears not. That deep discount seems to be a rational pricing of the high probability of future challenges. The market seems well aware of the fundamental weaknesses, the governance issues, and the geopolitical threats, and is pricing in a significant chance of permanent loss of shareholder value. It strongly points towards being a classic value trap.
That's a really clear synthesis, and it leaves us with a final thought, doesn't it? Considering that the recent technical strength, the stock price momentum, seems based almost entirely on that tiny sub-0.21% public float.
Yeah.
How long can that kind of speculative price action, driven by scarcity and perhaps retail hype, really sustain itself when the underlying fundamental governance and geopolitical pressures are just so overwhelmingly negative? That's definitely something for you, the listener, to think about as you do your own research. Okay, before we wrap up, just a quick reminder, Please do like this video and subscribe to the Stock Analytics AI YouTube channel. It really helps us out. And remember, for $499 a month, members get priority deep dives on the tickers you want us to cover. We're planning to cover all of the S&P 500 stocks over the next few months, and members get exclusive priority access to that research stream.
And if you just want a one-off deep dive on a particular stock you're interested in, you can always drop us a super thanks on YouTube.
Great point.
And finally, the important disclaimer. This analysis was generated by an AI system. It's intended for educational purposes only and should absolutely not be taken as financial advice. Please always conduct your own thorough research or consult with a qualified financial advisor before making any investment decisions.
Could agree more. That's it for this deep dive on MicroAlgo. Thanks for tuning in, and we'll catch you on the next one.